good morning and welcome to this week's weekly show. First of all, a couple of apologies. First one from James. Unfortunately, he's not well, so I've been parachuted in on short notice, obviously, to cover the news. As I say, we've managed to get this together quite quickly, so hopefully that should all be fine. Once after done our usual run through of the weekly news, Gavin's going to be interviewing Mark Boggett of Seraphim Space Investment Trust, and that's going to be really exciting. First thing is I wanted to talk about Edinburgh Worldwide and then it's NextEnergy Solar. Really important announcement from Edinburgh Worldwide this week. Iman? You turn the slide, please. Brilliant. Okay, so we've had this announcement from Edinburgh Worldwide. The board is proposing a 100% tender offer. It always is sort of quite a shame because it's going to bring an end to sort of EWI in its current form. But it's basically a response to Saber Capital's third attempt to seize control of the board and the trust obviously ultimately appoint itself as manager. I say it's a surprise because actually EWI has already sort of successfully twice fended off Saber and by sort of convincing margins as well. So if you sort of look at the numbers here, on sort of turnouts of 65% and just over 70% respectively, 98.4% and 92.7% of non-Saber shareholders voted against its proposals in the last two sort of EGMs. And you would like to think, or like to think, certainly we would have done that, it would have been done at that point that Saber would have sort of gone away, had a rethink of the approach, but sort of not. Literally 3 weeks to the day after the sort of second set of requisitions were rejected by its fellow shareholders, it came back with a third attempt. And essentially it's the same thing. It wants to put its directors on the board and effectively to take control of the trust. And really, so the board is in quite a difficult position because on one hand, obviously, it needs to protect shareholders, sort of all shareholders' long-term interest equally. On the other hand, it's getting the sort of problems associated with these sort of continued attacks from Saber. I know that for a long time we've very much been advocating that sort of EWI should be allowed to continue. It's current form, I'll sort of go about that a bit more. But actually, given what the board's now said, I think we sort of see their logic and we think what the board is proposing, and I'll go into that in a bit more detail, what we think they're proposing is the best outcome for non-Saber shareholders, basically, and are equitable to all. Mark, you turn the slide, please. Okay, as I said, this is sort of very much a disappointing outcome, particularly for James. I know he's a sort of shareholder in this, and it's very much not where he wanted to sort of see this end up. Just to recap, Edinburgh Worldwide is, one, if not the most growth-focused sort of global small cap fund in its peer group, and its strategy, being these sort of global small caps, is really well suited to its sort of closed-end structure. A whole sort of slate of shareholder-friendly measures were implemented last year. I think it's partly a response to the initial attacks by Saber, and performance has improved markedly. Spent a lot of time talking about this, but from our perspective, at this point, there's no reason to keep sort of EWI going. So, having fought it off twice, and given that we think we probably will win when this sort of comes up again at the AGM, why not carry on? Well, I'm going to answer that for you, Iman. So here is the sort of another problem, if you like. The last vote, the margin was actually quite narrow. So Saber has just over 30% stake. It sort of nudged up to that beforehand, but with repurchases, it's effectively sort of pushed it over. And when you consider the turnout, that 30% stake obviously gets voted in full, actually sort of translates disproportionately into 46.8% of the vote. As I said, shares as a whole still got behind the board and the incumbent manager and the strategy. And as I say, they won with 53.2% of the vote. But you can see the margins are not that big now. And here is the sort of key problem. To keep the sort of discount where it should arguably be, there are sort of further buybacks going on. And really, Saber's not selling into those. So it's feeling like its disproportionate share is growing. And so, the stake that it's likely to get in every vote, all things being equal, is getting higher. To fend that off, Edinburgh Worldwide board, we've got to galvanise an increasing number of retail and sort of shareholders effectively to win. And you can see, if they just keep on throwing back the same, as nearly happened with Bailey Gifford USA, because that just managed to avoid this by a sort of very tiny margin, Saber would eventually win. And this really is a problem. I'll sort of go and explain in a second, but that has another significant implications for non-Saba shareholders. Iman? So as I said, actually I've got this wrong, Saba hasn't offered 100% tender. Well, actually it has, but actually the board is sort of offering a 100% tender. And the key point is that this will almost certainly occur, Saba's tender will almost certainly occur before the SpaceX IPO. And if that happens, it's likely at the current valuation, and the value of this IPO, there's no, I'm saying no certainty yet because there's no indicative prices, but it could be huge. And there's a huge amount of excitement around this, and certainly with the sort of rolling of XAI into that and the sort of plans to actually put data centers, etc., in space and all the free energy that's in front. This could be worth quite a lot of money. But under the sort of existing proposals, Saba will offer this cash exit, but it's going to, this ain't happen before the IPO, and you can quite easily see how a lot of the additional upside that could be sitting in that SpaceX holding is going to conveniently be handed to Saba. So we think shareholders are facing a really unpalatable choice. They can either wait for the SpaceX IPO, but that will be after sort of Saba's offered its exit opportunity, and so then you capture the value of that, but then you'll be in the Saba controlled vehicle. Alternatively, they can exit now and they can give away any sort of upside in the SpaceX IPO. And what we think is probably the best option is what the board has come up with, because it's a far more equitable solution. Iman? So as I said, the board is also proposing a 100% tender offer. Now, this is going to be sort of structured effectively as two payments. So first of all, they're going to sell off the liquid assets, which are about 85%. So shareholders will get that cash pretty much sort of straight away, as soon as they've worked through that. But the idea is that they will also receive a sort of further payment once the value of the SpaceX position has been crystallized. Let's say that IPO is expected to occur within the next year. And I think if you look at what the sort of board said, they and the sort of manager have a lot of experience, have sort of good ability to judge when these sort of liquidity events will occur. So presumably, if that weren't able to occur, there would be another opportunity. But they're looking at that sort of time frame, and then once that sort of event has happened, there'll be a further distribution based on the proceeds that have been generated. Now, I'm going to say this is not a perfect solution, of course. This is not, SpaceX is not the only private holding that Edinburgh Worldwide has. And the way that it's structured, I think it's inevitable that shareholders will be still giving up the sort of potential upside in those other private holdings. I mean, I think we've long said one of the really exciting things about Edinburgh Worldwide is actually the long-term growth prospects of the portfolio. And sort of given where markets have been valuing these things, particularly when sort of further Saba first launched its attack. To us, it didn't really make sense to sort of give up that upside. But given that there has sort of been a re-rating of sorts, and given where we are, we still think this is the best solution on the table now. Iman? Next, we're going to talk about sort of NextEnergy Solar. Now, they sort of announced the results of their strategic review on Wednesday, and I'm going to say there's very, very detailed presentations on their website. If you're following this, I sort of seriously suggest you have a look. And so hopefully they've got the video there as well. But there's a 2-hour presentation on this at the sort of stock exchange, and they sort of set out this roadmap for the future. And I think the sort of headline numbers really are that they're going for a reset. Dividend target of 8.4p is going to be met for this year, but thereafter it is going to be cut. But they would hope to be able to grow it thereon. But for next year, it's going to be cut. It's going to be sort of, or it's anticipated to be in the 4 to 4.6p sort of range. The whole idea is this is going to free up about £40 million of cash. Now, so those who've been following NESF will know that with this sort of USS preference stock they've got, that actually they've breached the covenant. This is not a point. It doesn't affect the sort of day-to-day running of the trust, but what they can't do is buy back any sort of further stock. So it's then difficult to manage the discount. It's actually also difficult with the current discount to clearly they can't raise any equity. It's very, very difficult to find a way to sort of reinvest in the portfolio. Let's say if they free up this cash, and equally they've got other plans to free up some other cash, then this will not only pay down that debt and get it into the sort of target range where it should be. They will also be able to reinvest and grow the portfolio. We'll sort of talk about that a little bit more. As I say, they've set out this really, really detailed plan, and they think that they're going to be able to sort of target a sustainable 9 to 11% total return per annum. So it'll be lower dividend, but actually you're going to get some capital growth in there. And actually the overall figure, 9 to 11%, it actually, if you sort of read between the lines, looks like it's a bit conservative as well. A key element of that is actually at the moment, I think there's a limit of about 15% on storage in the portfolio, but this is one thing they're going to have to ask shareholders pushing for. They want to raise that to 30%, but there's lots and lots of good reasons to actually do that. As I said, they've already earmarked a further sort of 120 megawatts of disposals to free up further cash. And obviously, this follows up from the sort of phase 4, the completion of phase 4 of the sort of form, if you like, capital recycling program that's been in place and is finally sort of completed. And key issues, I was saying, for the last 3 years, it's been at this persistent discount. It's not been able to raise new capital growth, and the sort of key problem is looking out to the future without reinvestment. You get this sort of gradual NAV erosion over time, so you do need to be putting money back into the portfolio effectively to sort of offset that. And another sort of really interesting fact here is with the sort of falling cost of components, the payback periods on sort of upgrading and sort of repowering and augmenting the portfolio actually are sort of quite short. So you've got the really big scarce thing is the sort of grid connections. But what they've sort of been doing is coming in, and they've got a big program. These are about 2 years in, and I think obviously there's a few more years to go. But you can replace all the sort of solar panels with sort of double-sided panels, so you're getting sort of more capturing more radiation that way. They've got more efficient inverters, etc. They can actually strip out effectively a whole solar site and put in a lot more efficient tech and actually get the whole generation up, and it's actually quite easy to do that. And say sort of part of this, they're looking to increase the storage to about 30% of GAV. Key thing here is it will allow them to diversify revenue streams. So obviously at the moment, big chunk of this is solar, and they're getting some from the storage. But there's so much more you can do when you've got the storage. Obviously, it turns it into much more of a sort of form of baseload capacity. The great thing about this, it works really well when they're going to be repowering these plants anyway. I think the sort of key reasons they want to do this, if you sort of look out at the moment, the demand for mature assets is not quite, well, it's certainly not what it was. It seems that actually a lot of buyers want new assets, which obviously will work if they're repowering these things, they're getting that sort of thing. But also fundamentally, the sort of industry fundamentals remain strong. So if you look at the Clean Power 2030, that's still in place. That's mandating a sort of tripling of solar capacity, about 50 gigawatts, and has 4-fold increase in storage. So we also know, particularly with things like air, but actually moving to more electrification of transport, heating, etc. Electricity demand is only rising, and actually we need a lot more energy security as well. And this all pays into that. And as I said, they've mapped this out in huge detail, but the combination of all of these should provide sort of income and capital growth for the fund, and on a sort of 9 to 11% total return per annum that looks conservative as well. Right, okay, I think now I'm going to hand over to Gavin, who's going to talk to Mark Boggett of Seraphim Space Investment Trust.
Hello, and welcome to the In the Hot Seat part of the show. As Matt says, we've got Mark Boggett, Chief Executive of Seraphim Space Managers, about joining us. Thank you, Mark. Good to see you. Mark has been here before, and of course, he's best known to us as the fund manager of Seraphim Space Investment Trust, which has enjoyed a remarkable rebound in the past 2 years as its thesis on space technology has been proven and market conditions have improved. Mark is going to give us an update on the trust following the half-year results last week. After that, I'm going to ask him a few questions, and I'd love to put your questions to him as well. So do pop those into the chat box on your screen when you think of them. I'm sure Mark's presentation will give you a few ideas. Mark, are you ready to go?
Gavin, yes, thank you. Delighted to be here in the hot seat, and yeah, looking forward to sharing some thoughts with your listeners. It was just interesting just to hear Matt just talking about the two other companies before I came on. Talking about the SpaceX IPO, the largest IPO ever in the world. Why is it the largest IPO? Well, because space is such a giant addressable market, multi-trillion-dollar market. Then you went on to talk about solar and energy generation, and that's exactly what we're going to be talking about today as well. So some great segues there into the Seraphim Space Investment Trust. So I'm going to take you through a few slides, but I think really the interesting part will hopefully be when we get the chance to do some Q&A. So let me just start with the sort of scene setter for those that are not familiar with the fund. We are the most prolific investor in the space market globally. We've got a portfolio of nearly 150 space tech companies across both our public and our private portfolio. So we were the first manager to ever launch a fund focused on space anywhere in the world, which we did back in 2016. And the trust represents the one and only listed investment vehicle focused on space anywhere in the world. So our partners and backers include some of the world's biggest space corporates globally, and we continue to see a massive global deal flow. So we're seeing virtually all deals at all stages of the global space domain, and that provides us with an information advantage, an information asymmetry over the global sector. So what we do with this deal flow is we triage this deal flow between our early and late stage parts of the Seraphim organization. The early stage deals going to our venture fund and our affiliated accelerator program. And then with the later stage opportunities going towards the trust, SSIT. So we're a value add investor, we're a hands-on investor. We join the boards of most of our portfolio companies, and this allows us to build conviction. So that's the background to us. We've already flipped to the next slide, so perhaps I'm being told to get on with it. Let me just sort of explain again to those that are not familiar with space what the opportunity is all about. We've just been hearing about SpaceX, and really they've changed the market by building satellites that are smaller, lighter, cheaper, using components from adjacent industries, using 3D printing, bringing in reusability. It's taken the cost of sending a kilo into space from $86,000 a kilo today to $1,000 a kilo. And thanks to new innovations like Starship or New Glenn from Blue Origin, that price is falling even further. So space is very much open for business. There's a launch now. Last year, I think it was every 34 hours there was a launch into space. So not only is it low cost, it's now very available. It's like taking a bus. So how has the satellite industry responded to that? Well, this gone through its own revolution. Satellites used to be the size of a car or the size of a bus, costing $500 to $1 billion. And that's now been replaced by satellites that are the size of a fridge, the size of a microwave, or the size of a shoebox. And quite simply, what's happened is rather than building Rolls Royces to be launched into space, they've now discovered that a Mini will do. And actually, even a go-kart will do, because what you're able to do with these much lower cost and much lighter and smaller satellites is you can build up this global constellation of satellites. You can see the image there on the right about the Earth being covered by all of these thousands of satellites that look down at Earth, and they either provide us with a new form of communication, and Starlink is the one that most will be familiar with, but also collect data about the planet in a way that's never been seen before, in close to real time. And that data set is really where the value is. It's creating disruption across all of the big themes like defense and climate and smart cities, autonomous mobility, the drone economy, smart, food security, and then every industry you can think of, from agriculture to real estate to logistics to oil and gas, every industry is going to be using this data, this communication capability, and that's what's creating this multi-billion-dollar opportunity. And this is the reason why SpaceX is the most valuable IPO ever, and it's the reason why our portfolio companies are doing so well and why the fund is thriving. Let's just move to the next slide, where I'll talk about our thesis for investing. So a wordy slide, but let me explain it more easily. What we're focused on really in most of the investments that we've made and that the portfolio of SSIT is made up of is really around Space 2.0. These are smaller, lighter, cheaper satellites building large constellations that are providing services back to Earth. Each of these companies has different types of payloads, and these different payloads have different types of superpowers that provide new kinds of capabilities that to Earth that have never been seen before. So the Earth is already using GPS. It's a utility that we all rely on, and so do most industries. And what we're now going through is this next generation of capability that's been provided by the very companies that we invest into. So this is a real opportunity. There are real Earth-based customers, and this is the reason why the companies that we're investing into are growing so quickly. What is on the horizon today, and this is really very much here today now, is about the next phase of growth in space, which is about building infrastructure in space. So our most successful company, AST Space Mobile, today worth $30 billion, is putting cell towers into space that connect to any mobile phone with no hardware or software adjustment to that phone, providing 5G, voice, video, and internet capability. So that's around telecommunications. Then you've got data centers in space, huge amounts of talk in the press around SpaceX and how they're looking to use the advantage of data centers in the space environment to access low-cost energy that will give them that head start and that leadership within the AI race. Then there's manufacturing in the space environment. So we've got exposure to this through the portfolio in a company called Voyager, which is now listed on NASDAQ. So they're providing a platform for companies to come and build capability in the space environment. These are areas like biopharma. Every protein, every molecule behaves differently in the zero gravity environment of space. That changes the game for different scientific experiment, and there's a belief that there's going to be many scientific breakthroughs as a consequence of that. And then there's manufacturing more broadly in the space environment, and then it leads all the way to energy generation in the space environment. We've just heard about NextEnergy Solar, which is all about energy generation on Earth, but really the solution to our energy issues really, we believe, is going to be generated by space providing clean energy back to Earth, and that's now very much firmly in focus for the type of market that we're going for. So these are multi-trillion-dollar market opportunities. We're investing in the emerging leaders that are going to continue to grow for decades in these huge growth markets. Next slide. So these numbers are now already starting to come through, largely as a consequence of defense. Space and satellites are dual use. So every satellite is able to provide capability and services to defense customers just as easily as they can do to agriculture customers or oil and gas or insurance customers. So it's really defense that's driving the charts that you can see there, where we've been massively outperforming all of the indices, and we're really still very much only at the beginning of this journey. You're aware of these giant budgets that have been created in Europe, because Europe is now needing to stand on its own 2 feet. It has to invest in its own defense capability. It can't rely on the US anymore. That's been totally proven. And as a consequence, there's €1 trillion that are now committed by European governments to address this defense deficit. Space plays a really important role. Over in the US, you've got the Golden Dome, and as a consequence of activities in the Middle East, most countries around the world are now thinking about their own Golden Dome equivalents. So the defense juggernaut is really only just starting. Let's move to the next slide, and let's focus in on our largest investment, a company called ICEYE. This is a constellation of satellites that uses radar technology to look down at the ground in all conditions, day or night. Doesn't matter what the weather is, it can still see something the size of a dinner plate on the ground. And because of the size of its current constellation, it's able to see that virtually every hour. So being able to understand how the world is evolving, dinner plate by dinner plate, hour by hour, is very valuable to the defence market, and Europe in particular is really now focused on building up this capability. So the problem is, as you can see in the chart here, is that Europe just hasn't been launching its own defence satellites. It doesn't have this capability. So right now, we're starting from a position of virtually zero. So the governments have already got these budgets in place, and what we're now starting to see is the rubber hitting the road. So these contracts are now starting to come through into our portfolio companies. And the thing that you can see on the screen here is the announcement that we were forced to RNS in December because of its huge impact on the value of portfolio company ICEYE. They won a 1.7 billion euro contract from the German government to build a constellation for Germany that will enable them to be able to provide their own capability, but also share this data with other countries that have sovereign-owned capability. And ICEYE has been very successful during the course of the last 6 months. They've won contracts with the Swedish Armed Forces, they've won contracts with the Finnish, Polish, Portuguese, Greek, and also Japanese. So this is rapidly becoming a standard for European governments and international governments for this new type of capability. And what it's also demonstrating is that governments have really washed away their old-fashioned procurement processes that really favoured the primes, and they're now really focused on engaging with earlier stage companies that have the cutting-edge solutions that they need. In the theatre of war, the technology and the latest technology provides an advantage, and this is the reason why many of our portfolio companies are really now demonstrating rapid growth in their revenues and profitability. So one of the things that's just hit the news yesterday around ICEYE, while we're still on the subject, was that there was an interview in Bloomberg, which really talked about some of the key metrics for ICEYE that we've not been able to release to the market because this is a private company, but they've put them into the public domain themselves. So let me share some of this with you right now. So this is breaking news, and really I anticipate is going to impact our valuation going forward, and certainly the market's view on the value of the overall portfolio. So they've indicated that last year that they achieved 250 million euros of revenues. So this is last year, but incredibly, they've announced that they achieved 100 million or over 100 million euros of EBITDA profitability on that revenue. They've indicated that next year their revenues are going to be in excess of $1 billion. And that they are building 25 satellites this year, but that their manufacturing facility allows them to be able to build 100 satellites each year. So this is a great example of how these companies that we're invested in are now responding to the needs of the market and scaling up operations. So what we announced in our most recent results that I'm reflecting today is that all of our top 4 companies saw significant increases in their valuation because of this huge influx of customer demand and contracts through European defence customers, but also defence from around the world. So Hawkeye 360 there, as you can see on the screen, a massive beneficiary of growth. This is another one of our portfolio companies that's now reached profitability and is growing rapidly. And then you can see the other two companies there. And in the interest of time, I won't go into that. But what we did release during our results was that our top 10 companies that account for over 90% of our NAV, they are all growing revenue on average of just shy of 80% in the last year. So this is showing incredible growth in the rear view mirror. So what this doesn't say is what's going to happen in the year ahead, as all of these defence organisations are now getting their procurement processes into place. They're really gearing up on how they are going to be deploying this, and we believe that our companies are so well positioned for the years ahead. So moving to the next slide, we then just touch on some of the rest of the top 10 companies. You can see here on the right-hand side that our company is very skewed towards a handful of companies. We make no apology for that. We've doubled down on the companies that we believe are going to thrive in this environment, and thriving they are. Our bets are paying off, and what we expect to see is continued massive growth across this portfolio. So we're really only at the beginning stages of this growth. Just to sort of help you understand how important defence is here. So ICEYE, Allspace, Deorbit, all European countries, all focused on defence. Hawkeye, Leo Labs, SatView, all focused on defence. Zona and Zeno, all focused on defence. So we've really only got a couple of companies in the top 10 there where defence is not the key driver. We've got a nice mixture of European and US, and these businesses are very well funded. They raised 2 billion in equity funding last year, so that they are well positioned to build up their manufacturing capability to be able to provide the services that the market is demanding. So we've still got a reasonable amount of cash, as you can see here, 20 million or so. We've held that largely steady during the course of the last year by selling down on some of our listed holdings. So really the focus of the portfolio is on our private companies. So I'll actually make that as the final slide rather than summing all this up, because I think we'll get a lot more out of the Q&A from this session. So we'll skip this last slide.
Okay,
Gavin.
yeah, over to me. Mark, thanks very much. That sounds very exciting. Also, we are getting some good questions in. I'll come to those very shortly. But let me just start off with maybe asking about the oil price. I was interested in you saying talking about the falling costs in getting rockets and satellites into space, and then getting access to cheap solar energy when they're up there. But what is the impact of the surge in the oil price as a result of the conflict in the Middle East at the moment?
Well, ultimately it's inflationary, isn't it? Most of the supply chain around the world is delivered by boat, so increasing oil prices has a inflationary impact across everything. We're seeing sort of supply chains already being hit. Now, one of the things that we've been super focused on is investing into companies that are vertically integrated. So this is one of the reasons why SpaceX is so successful, because it's a totally vertically integrated company.
Now, Mark, I often hear that phrase. I mean, apologies if you're about to explain it, but what does vertically integrated mean?
Yeah, so it means that this is a company, or the company designs, develops, and builds its own infrastructure and satellites, and in the case of SpaceX rockets. It normally uses a supply chain that draws upon standardly available components. So they don't need to be shipped over from China. They can just go and buy them from anywhere. These are components from adjacent industries, the oil and gas industry, the mobile phone industry. So they're readily available components. And by doing this, these companies are sort of protecting themselves from the sort of global supply chain shocks like we're seeing at the moment. But what it also enables them to be able to do is to accelerate the development of their growth. They're not held back by being reliant on other third parties for components or other third parties for manufacturing parts of their systems. And what these companies do, if they have a element of the supply chain that's letting them down, they'll then start to just build that in-house. So they just won't allow themselves to become reliant on suppliers that actually impact the time in which they can operate. And if I look at the 9 unicorns that we've achieved to date, the one thing that they've all got in common is that they're vertically integrated. And this has really become a sort of focus for us over the last decade. And it really stands our companies very well right now to be able to continue to thrive despite some of the macroeconomic challenges that the rest of the markets are facing. Now, I'm not saying that everything that we've invested into is vertically integrated. I'm saying it's a theme that really drives, and companies like ICEYE are really benefiting from this right now.
Okay, well, let's thanks, Mark, and let's turn to some of questions from the audience.
Right.
Yeah, you referred to SpaceX obviously quite a few times in your introduction, and so we've got a question here. You know, I don't think we kind of know the answer, but it's probably worth asking the question: do you hold SpaceX? So I found it now. Do you have SpaceX in your portfolio? And if you do, how much? Also, what view do you have with Musk merging XI with SpaceX, using it to divert billions into a potential loss-making project? The questioner asked.
So we don't own SpaceX. When we set up, or when we established Seraphim a decade ago, our thesis was SpaceX is opening up the market for others to enter, and we're going to identify all of the other new SpaceXs rather than investing into SpaceX itself. So that's really been a thesis that we've held all the way through up until now, and that's where we stand today. What do I think about the merger, in particular XAI? I think it's absolutely genius. So let me just sort of unpack that a little bit, because I think this is a really interesting topic. So let's just take a step back for a second and just look at some of these things that Elon's done before. So Tesla, you know, he built that company, and it gave them a unique advantage globally in the car industry, a moat that they were able to really maintain for a number of years. SpaceX, likewise, leading the field, and they've still got a virtual monopoly over the global market. Look at Starlink, building out satellites to provide global internet connectivity. Nobody else is in that. They've already had a couple of years head start. And what he's proposing to do next is to leverage the energy power from space to power data centers, so that he's got an unfair advantage for AI. So AI is all about access to energy. China has a massive advantage because their energy is half the cost of the US. They don't mind burning coal for their energy. The US is half the price of Europe. So Europe is really massively disadvantaged here. So the leaders within AI, really, it's an energy play. And those that sort of have the best access to the lowest cost and the maximum amount of energy are going to have a massive advantage. So what Elon is seeking to do here is bring together the advantage that he has. He has the advantage of launch. So he can launch massive amounts of equipment into the space environment, where other AI players can't do that. He has the manufacturing facility that has enabled them to be able to launch the 9,000 Starship satellites. So he's effectively got the world's largest manufacturer of satellites that currently produce Starlink satellites. They're just going to flip those to producing data center satellites. This data center in space isn't like this giant building that's flying around in the sky. It's distributed satellites. So, you know, what, are you going to bet against him being able to actually create satellites that create a distributed data center? These are already going into space right now, and this is not something he's invented. We've been doing this for the last 5 years. Our third largest company in the whole in the portfolio, D-Orbit, has been doing this for years. So this is already something that's happening. He's focused on it to take the advantages for XAI. I think it's fantastic. If you think about the market leader for AI, what's going to happen? People want to use the best AI that's got the biggest capability, the most accuracy. And if you've got all of the world trying to use that at the same time, think about the energy that that's going to require. And this is the reason why energy really is the most important determination of success for the AI leader. So what Elon is doing is absolutely genius. Where I'm excited about it is that all of the other AI players around the world are having a sort of, oh my God, come to Jesus moment. Unless we start doing something in space, we are going to be left behind. What do we need to do next? That's great news for the space sector, great news for my portfolio companies, and great news for the overall sort of lifting of the tide of space being a really important and central market to the AI stack going forwards.
Okay, thank you. Let's turn to ICEYE, your biggest holding, and very interesting the figures that you quoted from Bloomberg there. Got a couple of questions. One wanting to know, what multiple, can you disclose this, but what sort of multiple on the revenues are you using, and what valuation does that put on ICEYE?
So we use a basket of 18 companies. If you go and have a listen to the video that I prepared in our results last week, we go into the detail of who are the components of those 18 companies. I'll give you an example of one of them that you can go and look at today yourselves, which is Planet Labs, which is listed on NASDAQ. That is a company that's very similar to ICEYE. They've got a large constellation. They provide data to the defense market. They've got revenues that are similar to the revenues last year of ICEYE, but they're not profitable. ICEYE is profitable, and we've heard how profitable is like eye-watering. And then you've got the other key feature, which is that actually no. Before I come on to that. They are valued today at $8.5 billion. With the averaging and with the illiquidity discount that we apply, we valued ICEYE in the realms of about $3 billion in our most recent figures. So you can see that
$3 billion, Mark. Is that?
Yeah. So you can see that that there are direct read-across examples that prior to the news that was put out to the market, that ICEYE compares very favourably to. Our expectation is that that these revenues as they flow through is going to all else being equal, and the comparable figures remaining the same, is going to lead to continued significant increase in the enterprise and fair value of ICEYE.
Okay, and the other question on ICEYE then was, the viewer saying that 40%, that eye-watering profit margin is 40%, or the 100 million EBITDA on the 250 million revenue. So, is that? Would you expect that sort of margin for ICEYE to continue going forward at 40%?
So look, I can't answer that question because I can't reveal financial information about the company that they don't make public themselves. But what it does highlight is just really the financial economics of new space. New space is about smaller, lighter, cheaper satellites that are built using components that are off the shelf from other industries to create a very, very ultra low cost infrastructure that provides a very high value data and communication capability. And what this really shines the light on a lot of folks, when they're thinking about space, they think about super high costs, super high risk, and what this is really demonstrating is that that's not the case. The infrastructure that new space is built upon is ultra low cost that leads to high margins. That's the reason why I'm in the business. That's the reason why I've committed my life to focusing on investing into the emerging companies and those companies that are going to become the SpaceXs of the future. SpaceX is valued, or is looking to IPO at around $1.5 trillion. The next nearest valuable space company is Rocket Labs, which was valued about $50 billion last time I looked. And in third place is one of our portfolio companies, AST, today valued about $30 billion. My expectation is that we are going to have tens of companies in the global space domain that are valued in tens and tens of billions of dollars. And I believe that there will be companies that will trend to $100 billion and more that aren't SpaceX. And my job is to make sure that I back as many of those companies as possible. And actually, I could go to the beach because I believe I've already done that. So that is what we are witnessing with the growth of the portfolio companies. All of our top 4 companies required an R&S this quarter because their growth rate was so meaningful that it moved the entire value of the fund. That happened on our top 4 companies. And I believe the market in which we're in, the drivers that we have of defense, of SpaceX itself and the IPO, and the likely impact that that's going to have across the board on valuations. And then space becoming a key element of the tech stack for AI. Those 3 drivers, in my view, are going to continue the growth that we've already been able to demonstrate within some of the companies.
Well, Mark, before you head off to a sandy beach somewhere,
I'm not going to any beach.
those top 4 holdings: ICEYE, Allspace, D-Orbit, Hawkeye, 360. Earlier, since they're doing so well, are they talking about plans? When may they float and do an IPO?
So I can't answer those as I think that you know, but just as we've given guidance before, 3 of the companies in our top 10 have indicated an interest to IPO. The environment for space IPOs with SpaceX is probably never been better. But these companies are focused on building out their businesses. They are growing faster. These management teams are very focused on delivering customer excellence. So IPOs is a big distraction. We've also got the negative influences of war in the Middle East and oil prices and the impacts on sentiment and inflation and interest rates that sort of is also sort of going the other way. So companies are focusing on the customers, focusing on growth, focusing on delivery. The timing around the stock market is outside of everyone's control, but I would be surprised if you didn't see our portfolio companies jumping through the window when the window presents itself. We've had an IPO last year. We had an IPO the year before. We didn't have an IPO that year before that. We had 3 IPOs the year before that. Our companies are aligned with wanting to position themselves on public markets, and we're very aligned for them to be able to do that. This is the reason why we established ourselves as a investment trust. We believe that the companies that we're investing into are, if we consider that this new infrastructure in space that's being developed, we consider it's equivalent to a new internet. And we consider that the companies that we're investing into right now are the equivalents of the Googles and Facebooks and Amazons. And the question is, when was the right time to sell your holding in Amazon? When was the right time to sell your holding in Google? And the answer is never.
So
and Mark, this is why we've set up the investment trust to allow us to be able to take a long-term view.
So that's interesting. So when these IPOs happen, what is your policy? Because clearly you're investing. You're primarily a private equity investor. You're investing in these companies before they get to the stock market. But once they float, is your policy broadly to stay invested, or
Yes.
do you take profits there and look for other?
It depends. It depends. We don't have a policy. Our policy is making money. Yeah.
So you want to hold on to the companies through the whole growth cycle, whether that's as a private or public company.
So look, we've been sitting on the boards of these companies for years. We understand the market dynamics, the competitive environment. We remain, the inside information that we have on these businesses remains valuable for 3, 4, 5, 6, 7 years after they've IPO'd. So it will be on a case-by-case basis. We took profits on AST. Because the enterprise value of that business went so high. It continued to trade upwards afterwards. We won't get these things right every time, but the point I've already made is we chose an investment trust structure to enable us to be able to hold something for 30 years if we want to. And we're not making any apology whatsoever about our portfolio becoming disproportionately focused. We're just in this to make the maximum amount of money it's possible to make. And we think we're only on the first step of a ladder that goes right up into the clouds.
Well, Mark, there's a question here that I was going to ask anyway, but I think it's very pertinent with the impressive recovery that's been in the share price, with the stock now trading at a premium, small premium above net asset value, and with all this growth you see, will the trust be issuing new shares? Will you come back to raising more funds to invest in this pipeline you're talking about?
What would you do in my shoes?
I'd issue some shares. I think there's the appetite for it.
Okay. Well, I think that that we're not allowed to talk about that. But I think that this market dynamic environment is about as favourable as it's ever been. I've taken 10 years to build this organization with a leading player globally in this giant growth market. And we've been starved of cash for the last couple of years. So I'm quite excited about what the near-term future has for us.
Yes, well, the questioner would say it would be great to see an investment trust like yours issuing shares. That has been pretty rare of late. Okay, so moving on. We've got a few minutes left. Let's move on to some other questions. Your update suggests that 80% of current portfolio revenue comes from defence customers. You've certainly been saying that is the main theme, but you expect this to flip over, the questioner asked, you expect this to flip up towards commercial demand within 5 years. What milestones need to happen for that transition to occur?
So, all of the companies that we're invested into are dual use. Only one of our top 10 companies consider themselves to be a defence company. So they establish the business to be a defence business. The rest of them, they're accidental defence businesses. So their other markets are much, much bigger than defence. And it's really, the rest of the commercial markets. So really what is the driver? So what's happening at the moment is there's an acceleration of the development of the capabilities of these businesses. So the technology roadmaps are shortening because there's dollars to drive that. And the size of the constellations are growing faster than they would have done if it wasn't for this immediate demand from defence. So what's happening as a consequence is that these constellations are reaching critical inflection points of size faster than we otherwise would have estimated. And really, the driver here is that as each of these constellations reaches a point where their data moves to once a day, to every hour, to every 15 minutes, to real time, as they go through that journey, the data becomes more relevant to a broader commercial customer base. So what's happening is that defence dollars are effectively making the space infrastructure more interesting to a broader range of commercial customers. So at the exact same time, what we've got happening right now all around the world in real time is all of the world's biggest management consultancies, the KPMGs, the Deloittes, the Accentures, all of them have stood up giant space teams. And what they're doing right now is they're going to all of their customers, these are the biggest customers in every category. And they're saying to them, what are you doing in space? And the answer in most cases is a shrug of the shoulders, not a lot. And they say to them, well, these are the 3 data sets that you're available to get today. And these are the 3 data sets that will come on board during the course of the next year. And here's what the near-term future looks like. And here's how you can use this in order to lower costs, increase profits, provide a better service to your customers. And what's happening thanks to AI is that it's now easier than ever for any of these companies to actually start to use that capability. So previously, only a handful of industries could afford to or have the skills to be able to use this data set. So oil and gas and mining and were sort of examples of sectors that would use this data set. Now it's open to absolutely everybody, because with AI at the heart of their operational data systems, they can now start to ingest this capability and use it for day-to-day decision making straight away. So there are no friction, no barriers to entry for companies being able to absorb this new data set, this new capability, to be able to actually make their businesses stronger, better, more competitive, and provide a better service to customers. So that's happening in every sector globally all at once. So what's ultimately going to happen is that with all of this increased demand is going to start filtering through to the companies that are providing this. And this is the reason why right now, you know, it's a sort of 80-20, 80% of the revenues are coming from defense, 20% from others. That's going to flip. And but the defense, whilst it's giant, and there are trillions of dollars of budget available in Europe alone, likewise in America, increasingly now in the Middle East, that they're going to be dwarfed by the budgets and the market appetite from the other underlying sectors, the automotive industry, the climate and sustainability use cases, the smart cities, the drone economy, the food security. And that's before you then start thinking about all of the sectors themselves, the real estate, agriculture, oil and gas. It just goes on. That's the reason that this is a multi-trillion-dollar market opportunity.
It's head-spinning stuff. Maybe it's I think the last question. We've got a couple of minutes left on our sort of hour slot. But the first question I got actually was, what kind of scientific breakthroughs do you think are coming? And perhaps when you're thinking about that answer, I was intrigued to see that you on LinkedIn there was a post from Seraphim Space saying biotech was a great opportunity. And you know, I've not heard that before. Perhaps you could say a word or two about that.
Sure. Yeah. So well, this should give your listeners some pause for thought. There is no scientific breakthrough required for anything that I've just described. So even when we go as far as providing energy from space to Earth to stop us being reliant on the black things that we dig out of the ground, nothing needs to be created. There needs to be no scientific breakthrough. 18 months ago, University of California put up the first satellite that demonstrated that using microwave, you can transport the energy back to Earth. All of the capabilities that are required just need to be developed. This is really a financial challenge and regulatory challenge rather than a technical challenge. So that is the thing that people need to get their head around. This is a financing play, and that's why this is an investment trust that's looking at it from a financial perspective is a great way to play this multi-decade growth. So let me then turn to biotech. So so biotech came into focus for us about 3 or 4 years ago when we were doing the due diligence on our first investment into a space station. So we invested into Voyager, and and that company is now listed on NASDAQ and is rapidly moving towards becoming the first private space station. We are now, and this is more through our venture fund than our public growth fund. The public growth fund is really focused on growth stage, so technology risks are behind it. We have private venture funds as well. What we're focused on is investing into the tenants of the space station, and that includes biopharma companies. So that know nothing at all about space, but they recognize, and this is proven over the last 30 years of the International Space Station, that every protein and every molecule in the zero gravity of the space environment behaves differently. So a scientific experiment undertaken on Earth has different outcomes in the space environment. Crystallization happens in 3D rather than 2D, and there are a whole range of activities that just open the door to potential new game-changing outcomes from scientific experiments in relation to drug development, drug discovery, right the way through to new materials. So think about being able to synthetically develop rare earth materials. These are the type of things that we're focused on because we believe these are going to result in game-changing outcomes. And let me just draw it back to what we're interested in: massive amounts of profits. That's what we're focused on, making money and positioning ourselves in these future growth opportunities. And by investing early, we're investing into companies that spend a fortune on patents to actually build a fortress around themselves, that when they find something that works, that they're able to actually have a moat around them in the way that SpaceX continually seems to achieve, where they've got 2, 3, 5, 10-year advantage from the other players in that market. If you think about drug companies that are able to get an advantage by using zero gravity, we're locking into those companies, and we believe that there's an exciting decade ahead of us.
Yeah, Mark, that really does sound very exciting. We have run out of time, but thank you so much for a fascinating presentation. You've given us lots of food for thought, and yeah, all the best as you explore what really is a new world of investing. So yeah, thanks to Mark, and thank you to you for all your questions. They were brilliant and much appreciated. That's it for today, but we'll be back next Friday. James Carthew hopefully will be recovered, and he'll be talking to the fund manager of GCP Infrastructure. But for the meantime, thanks very much for being with us, and have a good weekend.